Hello, Dilly. How are you?
Hello, George. I love
Uh,
that song.
really?
Yeah,
Boy, I'm
I
reading your
love it.
mind.
Like
I'm hitting all the right tunes these days.
you are.
Yeah, well,
Who picked that one?
I did. And if you
Oh,
want to know where it came from, it was inspired by my conversation with Samantha.
okay.
I forgot she's in the Boston area where I lived for decades. And that is typically one of the songs that one often hears at the Garden at the Celtics games. And so I figured, you know what? In honor of Samantha, my Celtics, who are now starting the second round against the Knicks. I think it's starting on Monday. I actually think the Celtics are going to repeat again this year, but famous last words. So, Samantha, how are you? Please unmute yourself. I think she's got herself muted. There you go.
I'm right here and I love that song. Thank you so much, George.
Awesome. By the way, do you ever go? Are you much of a sports fan, Samantha?
Mostly the Bruins.
Bruins.
Yeah.
Ah, so do they play that? They play that tune at the Bruins games too?
No, and we're not going to talk about the Bruins this year, okay? Move along.
That's like when people ask me about Bitcoin. Anyway, sorry. Oh God. Oh boy. I'm punchy. I tell you, Dilly, I just want to warn you. I don't know what it is this week. By the way, I'll make a
Is
confession here.
Mercury in retrograde? Maybe
You know,
you're
this
edgy.
may be TMI.
Oh,
I
good.
hope this doesn't go all over the Twitter sphere, but I came down with this bizarre case of conjunctivitis, pink eye. And usually it's a nothing burger. First we thought it was a sty, but I go to the doctor and it's like, oh yeah, like this is one where it's hyper aggressive and it's highly contagious. And
Yeah.
I basically like I had to cancel my weekend plans.
Mhm.
And so it's funny. I didn't mention this. I said to somebody privately. I'll say it
Are you
publicly.
quarantined at home?
No, but what you guys don't know is it wasn't yesterday, the day before. I did the entire space lying down on the couch with a hot compress on my head and the iPhone sitting on my chest. So there. I mean, my eyes, I want to gouge out my eyeballs. It's just so bad. So
You're a
bad.
hard worker, George. That's good. Hey, it's a
God.
Friday afternoon. I don't relish these times either because it's a lot of weeks of back-to-back intensity. So it's exciting, but it's definitely exhausting all at the same
Yeah,
time.
yeah, Samantha, what was one of your lines? I heard you recently. I was listening to one of your interviews, and you said something like volatility is my gig or something like that.
It is. It's actually, I just think volatility is outliers revert with volatility if we go too far in one direction or the other. And I jokingly say I raise teenagers. That's, I really do. I can see volatility coming. And that's part of kind of the reason why I wrote to clients January 5th that this was
Right.
going to be the year of volatility and
Yep.
not just one and done, but
Right.
yeah, relative to the low vol setting that we had in 23, 24, where the NASDAQ doubled in 2 years, I could see that it was going to come in. It's going to stay just because
Right.
it's 60 doesn't mean we're done.
Got it. All right. So hang on a second here. So I want to tee this up properly. When you were saying we were talking about how volatile this week was and crazy it was, you know the line from Lennon. I want to make sure I got it right. The line from Lennon, there are decades when nothing happens, and then there are weeks where decades happen. This market's more like there are weeks when nothing happens, and there are days when weeks happen. I mean, it is crazy some of these moves. Samantha, what was the day a couple weeks ago where the market was up like Qs were up like 12% in one day or something insane? I mean, that's like a year's worth of performance, like in one day. Like this is
That's
nuts.
what I kept
No,
saying,
it's
George.
actually,
I kept saying what a year this week has been.
Yeah,
I don't actually think it's a surprise. We had a tremendous 4 month, unprecedented drop. And we had policy intervention every single time the market has rallied in the past few years, actually since 2009. And it was literally April 9th. The cent actually queued it up at the 1 o'clock auction for the 10 year and said, calm things to the bond market. And then immediately after, 1:15, Trump came out and said, you know what, we're going to delay the tariffs for 90 days. Why? Because the bond market lost its wits the night before. We hit 4.5% for the 10 year, we hit 5% in the 30 year, and we had a confidence crisis. So he had to come in and basically backstop crashing lower bonds and equities. And we had policy intervention. It's different from the Fed and Treasury intervention that we've been, accustomed to under Biden, but nonetheless, delay of tariffs. That's what the market is hoping for and is pricing in, is Trump folding.
So Samantha. See, you're saying there's a chance. Is that right?
I'm saying there's always a chance, and the bulls are looking for peace deals. They're looking for trade deals. They're looking for tax cut and debt ceiling deals. And as long as we, have a liquidity hunt underway, which is quant speak, basically, for this amazing, grind higher in mechanical buying from CTAs and vol targeting funds and the rest, that we have bulls rejoicing, but we also have bears rejoicing because this is a quintessential bear market rally.
Yep. So I don't know if he'll show up today, but we've all seen his work as well as that of others. But John Roque, who's my favorite technician, along with Dave Nikoski, he's got this great table, and you know what? I'll find it and put it back up. I'll put it in the nest once we get rolling here, highlighting how bear market rallies are a feature, not a bug, and they can really rip your face off. And
Oh,
so,
that's my line.
yeah, well, I don't know who's
Feature
old.
not a bug.
Well, with all due respect to your age, Samantha, John, he's got a few years on you, but let's not get into a trademark fight over this.
No. I'm talking about when we were just
Yeah,
talking about the
yeah,
other podcast that was literally the focus of it. That this
yep,
market sell off was also a feature, not a bug.
yep.
Meaning, Trump administration is very adamant early and often talking about the overvalued dollar needs to go lower. Price of oil needs to go lower. They removed that intervention collar that's been keeping it bid, and interest rates need to fall, which, by the way, has not happened, which is why they keep browbeating both Trump and Powell into submission. And he is right now, going to be on the hot seat next Wednesday.
Okay, so you know what? We're gonna. This is a. I shouldn't say this. I'm gonna get in trouble because I got two lovely women on the stage. So, well, you know what? I'm not gonna go there. I'm just gonna say I will dispense with the introduction, and we're just gonna get straight into it because Samantha seems to be wants to get straight into discussion, which is great. And Samantha, I'm not gonna let you off the hook that easily. We're gonna come back later to talk about just who is this knowledgeable Samantha person that seems to know all this stuff and who I fall in love with here because we have the same worldview. All right, so let's tee it back up. So you were looking for a correction, reset, whatever, already last year to start to think negatively. And analogously, I'll just remind everyone, I was enchanted with Tom McCullen Oscillator fame. He had put out a piece, and we actually interviewed him, and we did a space with him back in December. And he was likening the rally in the run up to the 24 election to that of the 1980 election. Reagan got elected. And it was a case of, the traveling is better than the arriving. People were celebrating, budget cuts and this and that and tax cuts and whatever. And the market had a hell of a rally in 1980 and went up for a little bit more post Reagan's election, and that was all she wrote. And Tom, analogs, Samantha, I'm sure. I mean, analogs are interesting. They don't prove anything, but it could be a chart crime to put one chart on top of another. But Tom was suggesting that he was looking for a similar thing to happen this time. And the market kind of came and went with Trump's popularity ratings, and there were sugar plums of tax cuts, deregulation, smaller government, all this stuff dancing in front of investors' eyes, and then the market get going. It made its final high in February, but this Tom's construct I found to be incredibly useful. Sounds like maybe for slightly different reasons, sounds similar to yours. So okay, we had this correction. In terms of total size, it wasn't that noteworthy. Maybe what caught people off guard was the speed of it, and in particular the concentration of it, because it was the shiny objects, the market leaders that got hit the hardest. So Samantha, we did all that. And now we've rallied back pretty vigorously. The market's about I don't know how many days, and all the Fibonacci guys are going to come out and start talking about the 0.618 and all this nonsense. So, as they would say, as Dilly would say, Samantha, we are so back. Yes, no, like, can we just pretend like that was a bad dream? We're gonna go back to the way things were before, or do we have a lot of unfinished business to do?
Well, I would say in a nutshell, ignorance is not bliss. So we definitely had a concentration unwind as the liquidity started leaving. So Tom's methodology is I value very much. I'm an intermarket analysis guru. I like that's my thing. It's even stronger than my macro or my technical. I love cross asset analysis, but he and I do not have the same focus. Mine is on liquidity. So I'm looking when there are buyers, when there are sellers, and when one outweighs the other. So I'm really always looking, it's liquidity hunting. That's kind of like my job. So I could see that in December 2nd, actually, is when we started to sell. Net selling started to pick up underneath the surface before the market starts to roll over. So we actually create this kind of air pocket of risk when selling starts to step up, and then buyers step away, and it creates this air pocket. So it actually started rolling over. Remember, December 18th, we had that nice 3% downdraft. We had our first VIX spike of size since the yen carry trade unwind back in August. Anyway, fast forward to February, it did it again. So I could see the selling was picking up underneath the surface before the strong selling on February 21st, which just so happened to coincide with a big executive order that night by Trump limiting US investment in China and Chinese investment in the US. And then the thing just kind of snowballed, right? And it was part of the dollar selling off that had me coin that term early, that money goes home. So it was not safe. So, trying to find the liquidity drivers right now, it's very straightforward. We have a solid bounce off of after a 21.5% pullback in SPY on policy intervention, which was Trump and Bessent coming in, again, trying to juice the market to get excited, to stabilize. And then you have these kind of price insensitive quant funds that come in and position, and shorts have to cover. And the higher we go, the more nervous those hedges, those holding hedges are, and they start to unwind in the opposite way. So we get this reflexive bounce. And it's very, very typical. It was very strong in August 5th when VIX hit 65 pre-market. It was again strong in this most recent April 7th low before the bond market exploded on the evening of the 8th, and Trump came in on the 9th and delayed tariffs. So this is a game of liquidity. And when the liquidity freezes, like it did in the bond market on that fateful Tuesday, there was real danger. So there's a reason, macro and fundamental reason, why we should worry. But there's also kind of this systematic buying that enters, and we have to go with it. So I can be a macro bear, but I can also be tactically long because I can see the buying. That's all. It's a different process than what Tom uses.
So there's so many ways I could go with this one. So let's try this rabbit hole. So we saw a low, but have we seen the low, Samantha?
No. So my feeling is that um, concentration of power in large tech names, it may help keep equities bid, and it's not a surprise that these Mag 7, in large part, but we had 4 of the 7 report this week, that they would keep also the equity market, it kind of stays stitched together during earnings season. And it's very hard after 13 weeks of sequential downgrades, re-rating of earnings lower, it's very hard for them not to jump over. I mean, that's the game, you know that. So the problem is that concentration of power in large tech names, keeping the equities bid, is not going to help the U.S. economy grow. The falling dollar typically is, inversely related to helping, equities stay bid, but it's not going to help the US economy grow. And every single press appearance that Besant makes on TV, every day he's out, twice on Sundays, posting of tax cuts and trade deals, but it's not here, right? And so I'm always looking for the macro event risk that will interrupt the bullish flows, because we know that markets advance 80% of the time. So right now we have a very different regime, not just political regime, but also monetary regime. So that's the danger, is that we actually had pulled forward a lot of recession risk. BlackRock was out 2.5 weeks ago saying we are in recession. Apollo came out last week and said, nope, we're 90% there. We're going to be in recession this summer. So they've got their methodology, right? Very, very strong, looking at the economy, but the market is not pricing in recession or an unsustainable trade war with China, or money goes home, which is my mantra, right? For the past few months. The equity market is pricing in Trump folding, or Congress overruling the tariffs, and or a Powell capitulation, the bet for an FOMC meeting in June where they do a normative rate cut. So that's what the market is feeding off, plus these price insensitive mechanical flows that I call liquidity hunting. It's not fundamentals. It's not macro.
Brilliantly said, Samantha. I recall George Soros once, one of his better thoughts, lines that stuck with me in terms of how to make real money in the market. His idea was try to figure out what Mr. Market believes, what Mr. Market thinks that you believe is not true. Where do you have a variant perception? But more importantly, it's not what do you think is false that Mr. Market thinks is true, but when do you think Mr. Market will realize he's being had? So in other words, live the lie, go with the flow. But then you try to isolate that point. It's so hard to do this. To figure out when do you think Mr. Mark will realize he's been had? So, go back to, I don't know, the housing bust, 2008, 2009. We all remember it, the big short. And it's hilarious that we've got, Danny Moses and crowd, on Twitter and social media and whatever. But we all remember the scene in the movie where, those guys are shorting the housing stuff, well before the thing collapsed, and they were bad, almost out of business, and da 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 da. And then one day, I remember, I think I got the scene right. They're sitting eating breakfast somewhere, and up on the TV screen, the story of the day is New Century Financial files for bankruptcy, and they kind of they kind of look at each other, and goes, "That's it, pay dirt. We're finally here." And so, but up until that point, the street kept living the lie. Or you go back to the tech wreck, go back to the Nasdaq, Nasdaq 5,000 bust. I remember clearly March of 2000 where I was. I was in Midtown Manhattan at Morgan Stanley Telco Conference, and the market Nasdaq I think fell 200 points that day, 4%, for no apparent reason, and that was all she wrote. So you've got a similar dynamic going here, except Samantha. What I find it really complicated. I mean, it's always about liquidity. We know that, right? But I don't think it's ever been more a case where the stock market and financial asset prices have been so weaponized as a tool of economic policy. It's like you're a kid, Samantha. You remember, you play pinball and they'd have those mechanical pinball machines. And if you didn't like the way the ball was going, you'd like bang the side of it or tilt it or whatever. Okay. Well, that's what these guys do. I mean, and especially given that the size of the financial economy is so big relative to the real economy, and you've talked about it yourself, is the is the market leading the economy the other way around. So I just find it, I don't want to say well, I will say, I just think there's so little integrity in the markets now. The name of the game, yes, still is buy low, sell high, but they've biased the thing so much, they've distorted so much, it becomes hard. So where do you think, going back to the question, I know I'm rambling, it's later on a Friday, but, where do you think, like, I agree with everything you said, but when do you think, or what do you think the precipitating event will be where the market finally realizes that, this is, even if the tariffs do get solved, this, that, whatever, there are bigger fish to fry here, and we got a problem, and we're about to go into a recession, we're in a recession, the estimates are too high, stocks are expensive, and money's going home. I
So I
guess
track. Go ahead.
no, I guess so. It gets to timing or precipitating catalyst. Whatever your thoughts are. It's a disarmingly simple question, impossible to answer, but give it your best shot.
No, I think it's not so hard. It's watching liquidity very, very carefully. So, for example, inflation prints are lagging. So too is labor, right? Jobless claims have not ticked higher reasonably. I mean, above a key level that I have anyway. They just really stay in this la la land, which is great for bulls to continue this kind of illusion, right? But layoffs are starting to print, especially after severance pay runs out. You'll see jobless claims start to come in and start to track higher. Those types of things people don't think about. It's lagging. We probably have a perfect storm of when we see spiking higher jobless claims, by the way, which is really what the Fed needs to see in order to trigger their rate cuts. That will probably time with all this tariff driven inflation that kicks in. We've seen the headlines about supply driven worries as far as inventory going missing from the shelves. So we've got this waiting for us. We haven't dealt with this. We've got Q3 earnings we haven't dealt with. Recession risk pulled forward we haven't dealt with. This is fine. But I study more of the capital flows and the confidence. And we have, of course, a market that is well supported in the past with Fed Treasury and White House intervention. And right now, the way that is supported is through promise of peace deals, right? A forced armistice with Ukraine and Russia, which with every passing day looks less and less likely. With trade deals, the only one that really, really matters to market in a big way for small and business sentiment is China. And that is completely in, what do you call it? Era of blah blah, which is a colleague of mine who basically said you can't trust anything they say. But anyway, because U.S. escalated this trade deal, and now they're waiting for China to de-escalate it. And then, of course, really front and center would be tax cuts and the debt ceiling deal. Whether you're for or against it doesn't matter. But if these tax cuts do not get passed, it's an immediate tax hike, right? We're used to the cuts already. This is an extension thereof.
Huge.
So that would be an instant reason for the economy to go into recession a lot earlier. Same thing with the debt ceiling. Now they haven't resolved that. Memorial Day weekend is coming, and likely we get through May unscathed, right? We could grind sideways to higher just through options expiration, through Nvidia earnings on the 28th. But once we start getting closer to that Memorial Day weekend, and then the anticipation of these 90-day delay, tariffs into July 4th, June's going to look a little bit different, right? So for me, I'm going to continue to watch what the run on liquidity when it goes out of the system, like the ocean tide comes in and out. And the deeper it gets pulled back, the bigger the storm is coming. So for right now, we're in a little bit of a Goldilocks zone. And we're thankful for it because we have lots of tactical ways that we can trade, right? Long and short. But big picture, it doesn't remove the big issues of this changing kind of backdrop if we don't get peace deals, trade deals, tax cuts, and debt ceiling deals.
Samantha, I can just see it now. Based on what you just said, you said we get through May unscathed. And you know how sentiment follows price. It's the way it always works. I posted something last night. I was amazed. This tweet actually got pretty good number of views. It's by the way, Twitter just makes me nuts. I put a lot of work into a tweet, gets like no views. I put a tweet up yesterday. I just copied and pasted from Market Ear. It showed the month of April. There was no effort on my part. I just took some from Market Ear. It was 40 billion of retail buying in the month of April. It was like an all-time high. Retail is just completely undaunted by what has happened.
Or they're
Anyway,
front running the tariffs because they know what's going to happen.
right. And so, but what I'm just sitting to you listening, and it's like my skin is starting to crawl because like you think we're so back now. Oh my God. If the market goes up in May, like you're saying, may happen. Oh my Lord. It's the Dan Ives is going to be coming out with this crazy color jackets, turning positive on Tesla again.
Oh,
God.
there still are no downgrades on Google or Nvidia. Oh my. I mean, the analyst market isn't really great, right? We can't really go on that. But it is funny. McDonald's, for example, came out yesterday and said their comparable same-store sales are the lowest since 2020 lows. And yet not one single analyst is worried. Not one, there's not one zero sell on a Google or Nvidia, or it's just, that's the market we have. It is contrived. Ignore that stuff. That's all noise.
Yeah, it's like pay no attention to that man standing behind the curtain. By the way, by the way, we have Dilly and I. We never do this breaking thing. Like the thing I always talk to Dilly about. We rarely talk about what's happening in the market that given day. It doesn't really matter in the bigger scheme of things. So whether people listen to this recording today or a week from today, assuming the world doesn't change, doesn't really matter. But Dilly, I couldn't help but notice. I saw one of these headlines flip across just now. It says Nike asks Trump for trade exemption. It's like,
Oh, yes,
I
it's
mean,
coming.
I
Yeah.
mean, it's like it's.
Yeah, it's coming. It's like the early days of Harley Davidson that required, lots of intervention to tariff aggressively Japanese
Oh
motorcycles so
my
that they could
lord!
even survive.
Samantha, let's roll this forward a little bit, okay? So, math is hard. I know, so they tell me. All right, but I think the number was, I think we took in a total of 63 billion in tariffs last year, and total imports for like I can't remember, if it's 3.5 trillion, 4 trillion, something like that. And you look at all the exemptions left, right, and center, and even if you were to tariff everything, put whatever number in you want. Like the numbers just don't add up, and they want tax cuts. It's like you were saying, like we have to extend the current tax cut, otherwise it's tax increase. But they want tax cuts beyond that. All right, and so my question is, and I'm sorry to be so, and listen for it, Dilly. Analytical. I didn't say analytical. I go analytical. I'm an analyst. Okay. I'm sorry to
Yes,
pay such attention to details.
that's a good
Okay.
descriptor.
I'm sorry, Samantha, if I offended you. I don't know you well enough to say that. Dilly doesn't matter, but math is hard, and like I called this out on November 6th, with Elon running his mouth about Doge. And if you just looked at what they claim, at first it was 2 trillion, then it was a trillion, and da 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 da. And you take a look at, this the mandated spending, and the interest is like 85% of the budget. I mean, you can't get from here. The whole thing's nuts. So what I want to get to is there is a question here. As they would say, Dilly, it's really bad when I have to ask myself, will I land this plane? I don't know. I'm tired. I'm punchy. It's Friday afternoon. So Samantha, if you just roll forward with what you're saying, there's no austerity. It's all nonsense. Okay.
Correct.
The budget deficit is running well ahead of where it was last year. Spending is running well ahead of where it was last year. This is a guy who, they want rate cuts. If we were an emerging market and the IMF came in and it looked like this, they say, hey guys, you know what? You got to tighten your belt, pursue a little austerity, raise interest rates to protect the currency. We are doing exactly the opposite.
Yeah, because we've
So,
mhm.
so I think about this. Instead of making a statement, I'll just ask you the question. It's like my grandfather used to say: "Never ask a question you don't think you already know the answer to." Like it just occurs to me, like nothing good's going to come out of this. You mentioned the word volatility before. I mean, like to me, this is like complete insanity. So, could you just riff on that for a little bit?
Well, right now, this is why also stocks are responding, not only because the dollar is falling. So obviously, stocks in dollar terms, they look great, but not in gold terms. That's another conversation. But fiscal spending in general, we know that it's not under control. It's the opposite. And that's also supportive for equities. I mean, it's just for now. So these tax cuts, correct. It is they are the fiscal policy right now appears to be another like all gas, no brakes strategy. And it's very good to pump liquidity for stocks and gold, but bad for bonds. And that's going to matter sometime. And eventually, bad for bonds equals bad for stocks, right? So this is really a situation where there is not short term even pain. We have because there is no fiscal restructuring, and we don't even need austerity, but we definitely need restructuring. So this 50% larger bill, because that's ultimately what it comes into, believe it or not, the Republican tax plan includes approximately 1.5 trillion in new tax cuts beyond the 3.8 trillion
Wait, Samantha, stop. I'm glad you said that because I have a friend who was asking me this question. My friend wanted to know. No, seriously, the tax bill they're talking about is $1.5 trillion in addition to extending the present tax cuts.
Correct. And the current extension of the 2017 Trump tax cuts are 3.8 trillion. So that's a 50% larger deal. Now, 2024, the US deficit, we all know, was like 6.5% of GDP, right? Doge has not done much yet. Maybe they will. Maybe, right? That's everyone is hoping. But basically, these plans that I just kind of outlined, which passed, by the way, during all that tariff drama, terror, they add another 1.5% to the deficit. So we have a situation where the shift from, and that's why I said we're not just having a new political regime, but a new monetary regime. And people aren't really paying attention to that because it's very familiar to those in emerging markets. US hasn't been that before. So I happen to be very fortunate I run a financial research firm. I have a trading desk of 10, and one of them is a classical economist. He's brilliant. So he's very well versed in emerging market sovereign debt default. And guess what? He's looking at how this transition is overtaking the US. We are on the edge, and it's not a pretty edge, and he's not one who is normally worried until this most recent event where the confidence was removed very strongly, obviously, from the bond market, but also my thesis of money goes home in a crashing lower dollar with gold spiking. That is definitely a good trend long, right? We've got more countries that are settling trade amongst themselves outside of the dollar, outside of the petrodollar, and in gold and silver, but much more gold. So this risk off event that many people associate with a dollar squeeze is exactly opposite of what happened most recently in this big pull down that we had, right? Very, very big, clear message that money's going home. They're repatriating dollars and leaving, and they're not going to come back. It's money goes home, money stays home. That's my mantra. This is a
100%,
big
100% agree. And I have to ask, I'm going to channel my inner Dilly just so she doesn't have to work too hard. So, Samantha, what does that mean for Bitcoin?
So, oh boy,
George.
you picked the wrong person for that question.
Oh, all right. So Samantha, I'm recusing myself from this. Could you please address your comments to Dilly?
No, I don't know who she is, but I wrote a piece about this. Actually, you can even find it on my Substack. So I do have a mini me project, which is kind of sharing some of my analysis. And one of my topics just a few weeks ago was be careful what you ask for from Bitcoin. Trump's Bitcoin blessing can backfire big time. So all part of this, money goes home, money stays home, right? And everyone was excited. Bitcoin, fell about the same amount as the dollar. And then there was this, chart going around how, it was very exciting that we had a steady value of Bitcoin as the dollar falls. But how is Bitcoin measured? In dollars. So it's kind of a little bit of a chart crime, but Bitcoin is falling with the dollar. So it's something that will continue to disappoint. I think this is really not a safety trade, and neither are bonds for all the reasons that we just talked about, right? With the fiscal spending getting outside of the comfort zone. And by the way, let me go back on that because this will impact Bitcoin as well. When we have this market weakness on trade wars, right, and US bond selling, and it accompanied a falling dollar and spiking higher gold and spiking higher yields, right? We forget about that. That was just a few weeks ago. It was a really big deal. It was more of a systematic unbalancing. And it was the new regime that I'm talking about, right? Where we don't have the global liquidity like we had. It's money goes home. Bitcoin will succumb to this as well. But right now we're at this point in the play where continued servicing costs, we talk about it, but no one seemed to care. But this interest servicing cost as a percentage of US government revenue is approaching 130%. Now, my guy, Jeffrey Fouvray, and Luke Groman, another very popular voice on FinTwit, are aligned. And there are about 5 people who have grips over what this really means. But it means much stronger inflation. And at 140%, again, of interest servicing cost as a percentage of US government revenue,
Hold
it
on, hold on,
becomes
Samantha.
uncontrollable.
Samantha, Samantha, I have to interrupt you. I'm going to excuse you
And
because
Bitcoin will not save us.
you
That's
know,
what I want.
Samantha. Just as a point of information, I think like me, you're probably tired of late on Friday. I take your point, but I think you got a digit mixed up there somewhere. Respectfully, I'm not saying it's today because someone better. I should say it nicely, and someone's going to say, "Hey, Samantha doesn't know what she's talking about." No, Samantha knows very well what she's talking about. It's just tired on a Friday. The total interest expense is now debt servicing cost is running. Oh, it's like 3% of.
No, you're doing it wrong. It's interest servicing costs as a percentage of US government revenue. Government
Yeah,
revenue, money it takes in,
no. So just
not
hold on.
GDP, not GDP. So the government that the service debt against revenue received,
No, but
that is not 130%. We're getting closer. In fact, Luke Roman said we did hit it in February. When we hit it in February is when we started to cascade lower.
Samantha, it's not worth having a fight over this, but I think there's a terminology problem here. Let me just use hard numbers, okay? Interest expense is around a trillion, heading up to 1.5 trillion or something like that, okay? Total government revenues are about 4.9 trillion. All right, so pick your poison. It's 20%, 30% of total revenues right now. I think there's I'm not. I know what you're talking about, but I think there's, and again, it's not important because the import of what you're saying stands. But just some people get really bad shape and nasty on Twitter. Someone's gonna say, "Hey, she's right. She knows what she's talking about." No, Samantha knows exactly what she's talking about. But it's later on a Friday, and it's really not worth the detail is not worth fussing over. The only reason I'm bringing this up is not to sound like a jerk, but I want to preempt. And there's too many wise guys on Twitter. They may try to pull this stunt, but you know what? I'll tweet out the numbers later, just so everyone's clear about this. But anyway, getting back to the play, Samantha, you like gold, and we always try to make it so that it's helpful to people in the room. What should they do from an investment standpoint? And they're not going to day trade or keep, do the stock of the week or any of that nonsense. Okay, so for the usual investor, you may say, well, it also depends on where they are in life. If they're a boomer, they're a young person, this, that, whatever. So I'm not asking for so much for investment advice, but your views on markets. You like gold. I don't want to put words in your mouth, but
Yeah, no, this is not that I like gold. No, no, no. I like to be tactical and active. So I've got chase portfolio, swing portfolio, trend portfolio. I've got subject matter experts all around me who have their own
right.
particular attention, whether it's quant or
Okay.
fundamental or macro. My point is, I like to see when we have macro, I like to track macro event risk,
Sure.
liquidity hunting, sector rotation, stock selection on all kinds of time frames. What I'm
Right.
saying is,
So let's say for someone who, so if I say, okay, between now and the end of the year, next 7 months, all right. And you don't have to, you're just going to put some money to work for the next 7 months. You're not going to bob and weave. You're an individual investor. You don't want to look at the screen every week. What would you tell them to do?
be active. I mean, this is going to be, everyone has their own reference, right, of how they want to be passive or active. This is definitely a time to be more actively defensive. I think this is a fabulous time to position short soon, not probably until June, and then let the chips fall into Q3. If we can get some fabulous resolution around peace deals, trade deals, debt ceiling and tax cut deals, then great. The market is going to rejoice. But what are Vegas odds? And in the meantime, in the in between time, we do have a situation where there has been no fiscal restructuring. There's hope for Doge, but the reality is the numbers that I just read off, they're encroaching on
Right.
this, new era, if you will, of debt servicing and risk to our currency. And
Right.
this is nothing I've ever been focused on in the past. I have always been just kind of, okay, what's the market direction? I'm going to be, focused on and sector rotation and great stocks and how to
Sure.
play them with options. This is different. We actually have a very kind of backdrop of more danger than it is priced in. A lot of things are not priced
So,
in because the market's right
right.
back to near
So,
all-time highs.
so it's very much a macro-driven market. Are there any sectors that you particularly would say you like or dislike?
Again, it depends on the time frame. Time to short in gold, silver, and miners last week, but this is again a short-term kind of multi-week. It's also a reason why I felt that equities would get well supported because it would be a transition out of gold back into equities. Not, really excited about tech, even though the market seems to be. There is a lot more on the home front that we're going to have to focus on. People don't really like to play non-tech. It's not as sexy, it's not as momentum driven. But when these tariffs are rolled out, and I do believe, Trump's going to follow through with this, we're going to have to focus on boring US companies that are going to be able to take advantage of this transition. And lots of people don't want to kind of do the homework on that front, if truth be told. In other words, which ones are going to be in a sweet spot for potential export? Margins won't get, creamed. They're going to be just few and far between, honestly, of until we can get through this transition period. And I think it's going to be a really tough end of the year, but I'm on record for saying that last year, regardless of who won. So I'm the one who never who never made a recession call until last June of last year and said it's going to come in second half of 2025. All Trump has done is pulled it forward.
So
So
you
I
so
hold that
so so,
position.
so just to be clear for everyone, you're saying that we either are about to enter or are in a recession now?
No, I said we would have it pulled forward in the second half of 2025, and all Trump did was pull it forward. So the
Right. But I'm not sure you heard my question. So fast forward to current mark to market right now. Are you saying that we are in a recession now or
no,
about to go into a recession? What are you saying?
I think that we will have one now at the end of the year. My call was that it would pull recession risk forward. So this would be something that would be zero likelihood at the beginning of the year was recession priced in, right?
Right.
And I said, nope, recession risk is going to start to get priced in and it's going to be pulled forward from the end of this year, which was my prior call. We're in it right now. They've already pulled forward the recession risk. You've seen the BlackRock and the Apollo. Now we have the perception of recession. We're not in one.
Yeah, well, that's I think where my confusion stems from.
Yeah,
It's
no, we
one
have the
thing.
perception of a recession. We're
Oh,
not
okay,
in one.
okay. So you don't think we're in one now?
No, I do not.
Okay, fine. That's fair. Okay. All right, let's go. I could keep going. This is wonderful. I really love hearing you, but let's bring some others into the conversation. Dilly's, who do we have on stage? Anyone, please raise your hand if you have a
Yeah,
question.
if anybody wants to come on up, they can press request down below and we'll get you up here to talk with Samantha and George.
Awesome. So while we're waiting for others to join, Samantha, do you also look at any of the foreign markets? Do you have any opinions there?
Oh, all the time. So what I do is because I run a live trading room every morning, I'm going across all assets and all time frames and any stock that a client asks about. And I've got a team also, so we're kind of researching live. I'm kind of like Bloomberg Terminal when it comes to the live trading room, but I want very much to give as much um, uh, context, not just data. So it depends on what is being asked of me at the time, honestly, but my focus is on market direction. And then when that starts to slow and starts to turn the sector rotations to be in, for the most part, this is what I do every single day. So I don't have any particular preference or I'm watching all currencies, all commodities. I pay way too much attention to yields. I pay a lot of attention to the dollar yen carry trade. Definitely pay attention to the oil market. In fact, I had a surprise uh, call. Speaking of Jeffrey, my classical economist, I have had this call that oil would fall. And this was from last year, last April, that oil would fall into the $40 to $60 crude handle this year, at some point this year. And Jeffrey is very much focused on China and fixed income. And he surprised the heck out of me. And he said, actually, what were his exact words today? He said, this matters because he's brilliant. He's flipping off the charts brilliant. He said, I think the Permian, we're talking about the Permian oil basin here with companies in the US because of the cost, the price of crude falling very, very strongly. And I don't think it's done. And he doesn't think it's done. He thinks there's going to be a lot of bankruptcies in that area. And nobody's talking about that. So I know that the Trump admin, it wants lower energy costs because it will serve as a economic stimulus potentially to consumers later. But the short-term pain that we have to go through in the oil and gas industry could be much more severe than the oil and gas industry recession that we had in 2014 through 2016. If anyone remembers that, lots of bankruptcies. So that is his prediction. He literally just knocked that one out for clients today.
Interesting, because energy's been what energy does has a big impact on other asset prices. Samantha, you mentioned currencies. Do you have a view on what is your current view on the yen and on the euro?
So the euro, which has obviously been driven by a lot of fiscal spending expectations, kind of like that defense QE that hit when Trump said, we're not going to support, Ukraine actively, NATO actively. And they said, okay, well, we're going to have to take care of it ourselves. And that has obviously bid up not only equities, Germany, elsewhere. I mean, the emerging market and foreign countries have had an outsized, stellar response to money flow going there. Money has gone home, but it has definitely invested where they're going to be raising fiscal spending, right? And the currencies have also followed, no question, as the dollar has dumped relatively. The euro, however, is such a political animal and it is so overvalued right now. Yen is also a political animal. And this is a bigger deal for me. So I focus more on the yen because it's used in collateral, in basis trade and in funding lots and lots of NASDAQ and other, yield chasing. But the point is they're funding in yen because it's so cheap relative and chasing NASDAQ. That was part of the reason why we had such a drastic fall in July to August was the yen carry trade unwind. And that was a currency driven situation. This recent yen advance has been very strong for all kinds of other reasons related to the treasury market and the lack of confidence and the capital flows. So it's more durable to me. So I see a much better trade long this year in the yen over the euro.
Right. So I actually think the euro looks the euro. I'm not so sure about, but I share your optimism around the yen. And Swiss franc has also been very strong. Have you been noticing that?
Very much so, because that's where people, and funds and countries, whatever, hide out. It's an investment vehicle, but it's also a safety trade. I mean, Swiss National Bank has already gone NERP, not just ZERP, zero interest, but they're now negative. And they said they would. So they already predicted and prepared. So yes, that is why there has been a lot of rotation into the Swiss franc. But for the most part, the dangerous play is the yen moving higher because it does create this trigger of a basis trade unwind. It is also clearly, in other words, Treasury is a large collateral trade. Oil is a large collateral trade. We have yen moving higher. There's a de-risking in the NASDAQ. So you've got this kind of combo deal when you see our US yields falling with oil, that yen is there's a play. There's definitely a play there. So I'm always looking at even intraday, if truth be told, how the 10-year JGB is doing relative to NASDAQ. There's a lot of interrelation that is strong, even on an intraday basis. So yen for me is a big tell of potential volatility. And when it pulls back, it's also very supportive of US equities.
Right. And the Japan is the biggest net creditor on the face of the planet, or second biggest. I lose track with. It's just enormously important what they're doing with their money. And you now look at how much Japanese bond yields have risen. U.S. bond yields do not offer much of a yield pickup as much as they used to, and in particular, if you then think of it from the standpoint of a Japanese investor, and they have to hedge their U.S. Bond portfolio, there's actually a negative return. So I think we're really what's the line, Samantha? It's like never depend on the kindness of strangers. So I'm kind of wondering, as you roll forward with this and you think about our burgeoning um, borrowing needs, the fiscal profligacy, the fact that foreigners, increasingly have smaller appetite for our bonds. A lot of people talked about we might eventually get to some type of yield curve control, or forcing the banks, releasing the capital requirements of the banks, forcing them, compelling them to buy our bonds. I mean, I think bond yields are going higher eventually. I don't know what is your take on bond yields, and what do you think the government's going to do about it?
Well, one of the things that I look for in the short term that is supportive of equities is, in fact, the big banks requesting regulations to be relaxed around the SLR. So the SLR is a way for them to have fewer capital um, tied up, and that would actually be very supportive for equity markets. But the bigger issues that you're talking about around yield curve control are extraordinarily inflationary. So QE right now, given where we're at, kind of in this monetary regime change, right? From monetary dominance to fiscal dominance, and this is again not something that most are even looking at. It's a very inflationary backdrop. They can't do much. They can devalue the dollar. That's one thing. They can definitely not do fiscal austerity, or else the market will take a header. So they do need to kind of keep that dish spinning, but not too much, right? The fact that they're looking at or talking about QE is nonsense because of the inflationary backdrop. That would be very damaging. And the same thing with yield curve control. So right now, there's not a lot that makes sense from the, hold on, my cat scratching. There's not a lot of that makes sense for solutions that used to work. We've pivoted. It's new time. So I think this is one of the reasons why um, forcing money home out of markets, forcing lower demand for dollars, orchestrating gold lower. They're trying anyway with oil and now treasuries. They're all serving as collateral and basis trades to kind of keep the equity market bid. Right now, we're really hoping, bulls are really hoping for tax cuts and debt ceilings, bill to pass. Because otherwise they don't have a lot of levers left that they can pull
Right.
to manage inflation.
Seems like they're kind of between a rock and a hard place. They're trying to control a lot of different things all at the same time, be it inflation, interest rates, the bond market, the stock market, the dollar. I mean, you can try to manipulate or control any one or two of those things, but you can't have them all at the same time. And I don't think this is going to hold together.
Well, even Dalio, I mean, he's really shining right now, right? All of his warnings that he talked about, rolling out capital controls, which is, by the way, something that the executive orders included here, which is basically taxing foreign money that is here. Remember, we got a lot of foreign money that's invested, and that's why a lot of money is going home, because there are now threats of rolling out capital controls and taxing of foreign money, restricting U.S. money moving abroad as U.S. suspends potentially foreign debt service payments. That's Dalio's warning. He's been
Yeah.
on this for a long time, but all of a sudden people are taking notice and going, damn, he's got something there.
Yeah, well, respectfully, I'm reminded of the line: "If you have nothing good to say, don't say it." So I'm not going to respond to that comment. And my ire does not relate to you. Let's just leave it at that. Andrew, welcome to the stage. You have a question, Andrew? Please unmute yourself. Have a question for Samantha?
Oh, yes. Great to have you, Samantha. And I just wanted to ask you, we heard you're a little cautious on large tech and how you formerly had very, very strong words for NVIDIA and CoreWeave. And I just wanted to get some thoughts on those and how the market shifted towards other names such as Palantir, Netflix, or the likes of Duolingo recently. Any thoughts here?
What's the specific question?
Oh, are you still critical of NVIDIA and in terms of the market shifting towards other names outside of sort of the Mag 7? Do you see a continuation of that, or you think it's dangerous?
Oh, no, I follow all of it. So, I mean, in the case of NVIDIA, with sales flat in the US, they're making up that difference with sales to China, but that means they have to avoid some sanctions there, right? So, create different chips for that demand, form joint venture in China, go by way of Malaysia. And there are a few of us called, I guess, Twitter randos who, and I haven't done that fundamental deep dive where Malaysia has taken off exponentially, right? Like 1,300% in sales for NVIDIA into Asia, which is basically backdoor, as is Singapore for China. So they are still relevant. There's no question. It's not about the technology. It's about Trump is out to punish to punish them, and why we keep seeing a little bit of this dog and pony show also, right? Jensen was just at the White House, etc. So I think tactically it's fabulous trading environment for semis in general, and then the leader of the pack, right? It is nowhere near ready to fall over. We have falling gross profit. There's no question. That's that's the disappointment on the street. They don't have the same excitement around AI capex, and they definitely don't have this in the ecosystem. They don't have the same outsized margins as they used to. But ultimately, it's still the tech darling, and it's still everyone's go-to as it relates to semi-trade. But it doesn't mean I think it's legit. I think there's a lot of round tripping that is totally legal, that is obscuring the real price discovery of that stock and CoreWeave and others. It's not exclusive just to those. But the point is, you got cult darling stocks like Palantir, wicked overvalued, but trade it. I don't, have a particular marriage to any stock. I just think they're all trading vehicles, and some of them are in favor and some of them are out. Um, to me, there isn't any particular rotation from Mag 7, those kind of balance sheet heroes, into a Palantir, which is very, very different, right? It is, you could treat them all the same. They're trading vehicles, and sometimes they're in play and sometimes they're out.
Right. Hey, Rusty, good to see you. What's up, Rusty?
Hey, George. Sorry I'm late to it. Closing some things up, but I've already run in, and wow, this is amazing. Thank you so much, Samantha. I got a question and you may have covered it, and I apologize, but um, Latin America, just in general, what are your thoughts?
Not as great as Asia, but obviously it has also had a fabulous kind of oversold bounce, right? So you can see where there's temptation to go back and invest more heavily in Latin America. But I think there's still a lot more power in Asia. So the hardship, of course, is positioning for blowback by the Trump administration for US investment in these Chinese ADRs. I'm not even talking about Chinese businesses, right? But in the most recent case, their executive order and dissent coming out saying, yeah, we really want to limit US exposure to China investments. They kind of gave this feel like they might do a delisting. In fact, they said nothing was off the table, right? So that made kind of investors nervous. But the fact of the matter is, those are some of the most gorgeous plays, right? Baba and such. So those are the ones that have, I think, the longest runway, but they have this headwind of intervention by the powers that be. I don't think they're going to do a delisting of these Chinese ADRs because it would send all the ADRs into a tailspin. It would be very, very, very negative for market participants and for market sentiment, right? So I don't think that's going to happen per se, but they're threatening. So it's definitely limiting interest and exposure in those plays. But I think those are still better. But I don't discriminate. If it's right now, Germany's just run up too much too soon, and stuff that's coming up off the bottom, like a lot of plays in Mexico, they just seem like they're hitting resistance after really nice bounces. But as far as durable trends, there's a lot, honestly, in China, and it's difficult to access it now because of that headwind. But I think that's still going to outweigh Latin America.
I agree. Thank you so much. That was a perfect answer.
Thanks. Let's keep it moving. Eladio, good to see you. What's on your mind?
No, just came to say hello. Bottom line is, we just saw an amazing, 9-day run. And I think we're going to see a leadership change in the Mag 7. That's already transpiring. A lot of it is skewed because of the exposure that certain entities have to China. Are we allowed to go into the Mag 7, or are we, or you don't want to?
No, that's fine. Just if you got a
Anything.
question, if you got a question where Samantha follows those stocks, go for it, Eladio.
Sorry, can I discuss individual names within that group of Mag 7 or not?
Yeah, for sure. If you got a question for Samantha, that's great. Go for it.
Okay, well, look, Samantha, I agree wholeheartedly with what you said. I honestly haven't invested in the emerging markets in 20 years. And there are areas of the market I just don't invest in. And that's one of the areas. I just think that we saw a skewed move where the markets in this global world had all the money went to the United States. There was obviously a fleeing of capital from China like we have not seen, specifically right after Xi decided to get rid of term limits. And he basically, and Jack Ma disappeared. That's how the communist system works. And so I stick with the United States. I have a problem with Europe. I believe they're in the middle. They're socialist, overregulated. To me, socialist is it can be democratic, but it's overregulated. And I frankly think the United States is the best place. And I think money's going to rotate back to high quality tech that's innovative and disruptive. And Apple is no longer there. It just isn't. And it's too exposed to China. I think that the leaders out of this are those that are the hyperscalers in AI. If that's all I have to say. I'd like to see what you think, Samantha.
I think you should trade your conviction. That's not mine, but I think you should trade exactly what you know. And there's no argument that, especially on the Apple front, they do more in buybacks than sales right now. It's a little bit worrisome. But for the most part, you're talking about a time frame that is longer. Never bet against America. I wouldn't disagree with that.
100%.
As long as you can weather the waves of volatility. So if we get a 40% pullback, it's going to make it much more appealing for your AI ecosystem plays, but they're going to get hit hardest in the process, right? So it's all about being able to
well, I agree, Samantha, with the hardware, but I'm talking about the hyperscalers. The hardware area, the semis are toast. The market found a seesaw effect for about 2 years where only semis and the Mag 7, or Mag 6 without NVIDIA, though there was a rotation between those two, and they monopolized the global markets. I don't even know. I haven't asked AI to find out, but the monopoly isn't just in the United States. Their market cap is succeeded together the balance sheets of many countries, and I think that leadership is going to return and always come back to tech, especially when we're doing the same BS, with quantitative easing, debasing the dollar, which is what's been happening. And when that happens, you do nothing for the economy of the world at all. You only give the appearance of things improving because asset prices conversely move up against a debasing dollar.
Well, you are definitely the rule book of modern economics, right? It's run on debt, not real investment. But with this new political regime, with the new monetary regime, we could pivot very strongly, be forced to pivot very strongly into real investment, in which case your thesis is going to get dinged, because the future economy will need to revert back to real things, not paper. So on a software front, I worry, just because this built up concentration risk that has been hiding out in the Mag 7 and your beloved hyperscalers, we'll also see more unwind, not less, as volatility enters the market in recession and in basis trade unwind, yen carry trade unwind. This is not going to be as safe as I think you think it is. That's my only warning.
May I ask you a question then? How are we going to refi $6.5 trillion in June with rates 3 to 6 times higher, or 4 to 7 times higher than when Janet Yellen stupidly refied all that debt when the 10-year was at 0.7 and the 30-year was at 1.8? Well, you know the rates now. And the one thing that isn't working right now, everything's working in Trump's favor, especially with China crying uncle yesterday, except for the 10-year. How the heck are we going to refi $12 trillion refi? That's in addition, we're going to have the $2 trillion that we're going to have to borrow in the 12 months. That's the problem.
Yeah, well, it's part of the problem. The maturity wall is definitely there, but keep in mind that they are also, I mean, this is definitely, the answer is not, they're going to do it poorly. It's really hard to get around that, which is another reason why being too exposed to concentration risk can come back to bite. So moving forward, we've got a situation where the dollar has no incentive to move higher by this administration, none. We've got an incentive where they're going to try and keep, fiscal spending, because that is obviously that monetary illusion of economic growth. But in reality, yields are a big danger. They don't see it yet. Inflation is a big danger. They don't see it yet. How they orchestrate a soft landing and or recession to bring down yields, I don't even think yields will fall below 3%, right? I don't think we're right now at 4%, but I don't think we're going to see below 3%, even in a deflationary impulse, which is what normally happens when the hard data hits and recession triggers, lower prices in equities.
Yeah,
We could
Samantha.
absolutely have a stagflation type of backdrop where economic growth.
Yeah, Samantha. Let me ask you this. This really isn't on anybody's bingo card, but what are the chances that, I don't know, yields go, say, to 5.5 on the long end?
Very high. I mean, they're trying to get the trade deficit right under control, which is part of and parcel of why money is going home and dollar is falling. But it's going to be very difficult to thread that needle of keeping yields under control. They can't do it with the same suppressive tools they've used in the past because the inflationary backdrop is too strong from the trade wars. It's too strong from, just inflation expectations by consumers are what, 7? That kind of creates the self-fulfilling prophecy right now of recession risk getting pulled forward, but it's not here yet. So how they're going to pull this off is likely through continued devaluation of the dollar, which means dollar will go lower, right? We're not talking just 95, but it'll break through and, could be down another 10 points. We're also talking oil falling. Oil has already, hit the 5 handle. It's not supposed to do that. It's not supposed to drop below 65 crude, right? And it's likely heading lower. The yields are the one big, hairy problem, and they don't have control over it. And that's the worry.
Yeah, well, I'm with the Laduc on this. I it's a real problem. I mean,
Wow, Samantha, that was the most intelligent answer I've heard in about a month. Wow.
Thank you.
I will say, I've been saying though, this is the problem. Everybody thinks Trump is stupid. Okay, I'm sorry, he's not stupid. Does he have a strategy? No, he doesn't have a strategy either, which is scary. But because we could all agree that this was throwing spaghetti on the wall and tipping the Titanic as far as we could to see what he can extract from everybody, including the American people and the market. Was he trying to slow the economy down forcefully to push us into a recession in order to control those long-term rates? Because the Fed can only control those long-term rates with quantitative easing or quantitative tightening, because as you know, the Fed funds rate is only on the short end.
So what's the question?
The question is the Fed working against Trump, or is Trump working against the Fed? And who will win?
Neither. So there's a lot that Trump is definitely pulling off, right? But there is no way that, a few rate cuts are going to fix this. So I think, Powell capitulation is coming for these normative cuts until we have a reason for more accommodative cuts. But there's no part of me that believes that that's going to be enough. And there isn't any fiscal control or restructuring that we can see durably right now. And the only fact of the matter is that the dollar is falling, which is helping tremendously, honestly, for things to look better than they are. That monetary illusion, right, of stocks moving up and dollar moving lower. And this is going to be, I think, the strategy of chaos that Besant talks about, and I've written about that for Trump as well, your same sentiment, isn't the issue. It's really, how are they going to handle a sovereign bond duration shock? We had a mini one on April 8th, which is why they came in on the 9th and delayed tariffs. And the market bounced 10% in one day. Not a surprise.
The buyer of last resort, Samantha, the buyer of last resort. The Fed is going to reintroduce quantitative easing, but it should be limited.
I think they'll stuff it on banks first. I think they'll do that SLR relief. I think Diamond will get his way, and that will allow them to stuff more bonds. But this, hold to maturity business is just biding time for an accident. So I still don't think we're going to get away with it, but we are definitely pushing it down the road a little bit. And that's why markets are also doing what they're doing, right? We did the leverage unwind at cheap prices. They come back in until the next global margin call.
Say, Samantha, let me ask you a totally different question. So, you know, as Yogi Berra famously once said, predictions are difficult, especially about the future. And, Mr. Market's a very humbling teacher. There's the great Walter Deemer says, I forget the exact quote, but something like, job of Mr. Market is to embarrass as many people as possible. So if I said to you, Samantha, I'm going to give you two possible outlandish outlier for possibilities. One, let's just talk about S&P, just for lack of a better example. S&P is 5,700, wherever it is right now. That S&P 7,000 is going to happen. Much greater change. S&P 7,000. We had S&P 7,000 sometime in the next 12 months, which is not on most people's bingo card. Flip
It
side.
was beginning of the year. Every
Yeah,
large
Samantha. I know, but I'm talking about going forward, not backwards. So, some people are very bearish right now. Okay, so I mean, all right, make it 7,500. I don't really care. Okay, S&P 7,000. All right, is okay, or S&P 4,000. If I asked you which one of those is more likely, what would you say?
Well, I already had my call, right? That we would fall at the beginning of the year, 48.78. We pop back up to 6,000. And the next time we roll over, not likely before end of June or July, we see 4,000. So that's my call for the year.
Okay, so you think we're going to go to 4,000? Okay, all right, that's a call. That's definitely a call. And let me ask you a slightly different question. This is less about a call and more about just in your experience. You know how life is. I mean, sometimes the market gives you a lot of perceived opportunities. Other times you don't see a whole lot. Things are pretty finely balanced. So this isn't about whether you're right or you're wrong. It's more about conviction. Like sometimes if you're playing tennis or playing baseball, you see a ball or a pitch you really want to go for because it's like this is in your sweet spot, right? that you got to go for, right? Other times, again, let's just stay with baseball. The pitcher's not really throwing the ball over the plate too well, or it's around the corners. You're just not liking what you're seeing. It's just hard, and you're like, damn, this is too difficult. I get, and so the opportunity set is not linear. I mean, sometimes there's a lot to do in the market. Sometimes you're seeing a lot of intermarket relationships that are incredibly compelling. Other times, it's not so obvious. So the question I want to ask you is, like, right now, is your conviction pretty high, like, about things that you're seeing? Do you think there's a lot to be doing in markets right now, or as for many people, they're just getting worn out by everything, and it's getting to the point where some people are just getting, I don't want to say bearish, but just like getting exhausted by the whole thing, and it's hard to figure out which way the wind is blowing. So I guess the question is this a high conviction or a low conviction environment for you?
It's chop, meaning it's very high conviction on the calls that I still have, meaning big picture, we already rolled over, we're bouncing next 4,000 this year, probably not until third quarter. My conviction of crude falling into the 60 to 40 handle, which I made last year, I still have it. I can still see it. I can see it even clearer now, right? So I still can see 40, not negative, right? Like we had post COVID. I can see the 10-year, 2-year yield curve moving up into about 90 basis points, the steepening. That's the time to buy bonds, not before. I mean, for a durable kind of trend, right? I'm not talking about the week to week, and I run a live trading room. I've got day to day. So when you're talking about high conviction for stocks, I have a few, that's different. That's kind of like a file drawer type thing. And then there are just, why is everyone in such a big hurry to pick like this is normal? We're not in a bull market anymore. We broke the trend. We fell precipitously for really good reasons, and now we have to wait for things to repair. A V-shaped bounce is a quintessential bear market rally. It's behaved perfectly with policy intervention on April 9th. In the meantime, 10-year treasury yields, when they're rising and risk assets are selling off, that's a warning. US credit spreads widen 200 basis points. That's a warning. They've come back in and tightened. Doesn't mean it's all clear.
Right.
The term premium is rising. Bear steepening of the yield curve threatens, until banks can get their SLR relief, and then we're going to have another rally. The Fed talk of cutting, but long ends don't fall, or they even rise. That's another risk. By the way, gold is the new VIX. VIX is contrived. It's useless. It's a mean reverting, animal. Large auction tails. We have small ones, but we haven't had any big ones. Inflation, is rising with yields. Dollar is falling with yields rising. Like all of this stuff is happening. So I see that as a big picture. Fiscal credibility is eroding, and markets are starting to price in higher risk that the US is going to have some trouble, right? So I don't think that makes for a great backdrop, fundamentally speaking, especially when we've got some uncertainty out there around trade deals and peace deals. And right now, we just got to get through the tax and the debt ceiling deal.
Right.
And then I think we'll get some more direction. But for right now, it's low conviction, except on a smaller time frame.
Sure.
But big picture, I'm still high conviction of a rollover into the end of the year. That includes equities, that includes bonds, and that includes oil, and that includes dollar. Full stop.
Other than that, Mrs. Lincoln, how was the play? So, one more asset price question. Then I want to talk about what you actually do. So, I continue to look at gold. Forget about the short term. I have no idea. But over the next year or two, how high do you think gold can go?
Higher. It's really, why? It's in blue sky. For me, this is the best setup. I don't mean to pull back the next few weeks. That's very, very predictable because it's, again, letting some of the air out of that bubble. And it allows for equities to catch a break. Perfect. But big picture, once you get a stock in blue skies, do you put a price target on it?
No, but what you can say with a stock, here's how I would respond to your question. Ask me a question. If I own a stock, they come in different flavors. Some maybe like, let's say you had a steady Eddie grower, it's growing 10, 12%, whatever, and it's good
You can't
cash
do
flow.
that for gold.
Hold on, let me, yeah. So like a stock like that, yeah, I'd expect it to perform well, but it's not going to go up. It's not going to 10x as some like to say, but some Bitcoin people will say Bitcoin's going to go to 1 million. Some gold people would say gold's going to go to 5 or 6 thousand. So just because something's in blue sky doesn't, I mean,
Okay,
blue,
here's an answer. Here's an answer. Gold is going to go up until the US Congress balances its budget. How's that?
I can't think of a more bullish statement than that. So there you go. So
Checkmate.
it's Samantha. So you run a trading room or whatever. Can you just talk about like what is this trading room and what do you guys actually
No, I
do?
run a financial research firm.
Yeah,
So I
what do
run a
you, yeah. So what do you guys do exactly?
Okay, so I have a trading desk of experts. I am focused on all assets, all time frames, all types of clients, retail to institutional. I love this game of trying to figure out where we're going next and why. So I happen to not get tied into a particular silo of macro or technical or fundamental or quant or sentiment. Or intermarket. Intermarket is what a lot of the Tom McClellan does. I love it all. So I'm busy scanning and synthesizing all of that and putting these, the dots together into words, and the words form sentences, and the sentence form paragraphs, and the paragraphs form, chapters. The point is, I'm really stalking all of it. So that allows me to be very flexible, also bullish, bearish. Like that's no problem either. I don't have any particular restriction. Now, I happen to like to collaborate. So I brought in subject matter experts like Jeffrey is very much fixed income and emerging market and specialty situations. And Hans is an options mentor and trader and portfolio manager. So there's lots of hedging strategies that helps clients as well. I have momentum traders. I have Elliott Wave experts. I have futures traders. I have oil traders. I got it all. So I cover all the assets and all the time frames. It's not just me. I'm just the loudest one.
Right.
It's
So
my company.
got it.
But I'm the market timing person that's not afraid to make the big calls. But I do it in a collaborative way with my team.
Got it. So if one becomes like once, we're not here. This is not meant to be an infomercial. This is just Samantha unchanged. This is fantastic. But if one wants to become a client of your firm, you offer all types of different services from the smallest retail investor up to the big institutions.
That's correct. 3 levels of service, and including hand holding. Like there's lots of custom trade support. The folks that aren't familiar with options, or those who manage money and want a particular view on a particular asset or time frame. So there's a lot of custom engagement. That's why I run a live trading room.
Got it. What does it mean live trading? I'm sorry. What does that mean exactly? Like
Exactly what it sounds like. I'm monitoring market moving news. I'm answering questions. We're setting up trades. We're managing trades. It's very much next.
so if I become a client and I go online, is there like I can hear you guys talking or something? How does this work?
Yeah, you get access to our Slack workspace, where we post our analysis and trades. And then actually, I have 2 trading rooms, but I run the one in the morning. And then I have my team that continues throughout the day, my live training room moderators. And so they continue for the rest of the day and support clients. So, yes, it is live. It's Zoom. It's recorded. It's closed caption. It's
So I can just listen in, and if I'm inspired by one of those ideas and something makes sense, I can just kind of follow along. And
correct.
yeah, that's interesting.
Yep. And I post every day. And again, I do my intermarket. But everybody is contributing their particular views, like Jeffrey coming out and saying the Permian's going to go bankrupt. Like,
Right,
where'd that come from, Jeffrey?
right. I got it. I
Right.
got
But
it.
then he puts together his thesis and writes that up. So we cover a lot, which is why I can kind of field a lot of questions. You might not agree with the answer, but that's my gig.
Got it. You had a question follow up?
Yeah, wow. Sounds like you do what I do. I use correlations. I think they're the most powerful flashlights into glimpses of what could be, in spite of the unknown variables, such as a trade war and possibly a president that, well, deliberately tried to lower the stock market and create the havoc that he did, which is a fact. Whether intentional or unplanned, that's up to others to decide. But I still think they were throwing spaghetti. But correlations, how important? I have about 2 dozen. They change. They could be transitory. But for instance, the 10-year yield and risk assets, starting from crypto, which I consider a derivative of the QQQs, going all the way to value. What do you think, Samantha?
Oh, it's my secret sauce. There's no question. My ratio analysis is why I can make the calls I do, and early. Even before Trump got elected, like seeing that we were going to have issues, monetary side coming in, recession risk pulled forward. He's just expediting it, but it was already in play. Oil falling over, it was already in play. A lot of that has to do, you call it correlation analysis, across asset. It's ratio studies and just familiar, right? We kind of interpret the market in a language that we understand. And my intermarket analysis is part of my strongest skill set. And I can then break it into a 2-hour chart. And then I can see how correlation with oil and yields and dollar and gold are moving with equities, with yen, et cetera. So I can put it together. And now I visually got patterns that repeat that I'm looking for. That's very powerful.
Very good. I have one more question, and gosh, I forgot it was so important because I agree 100%. Oh, I know what. Samantha, you're not wrong about everything if we were static, but we're not. We're very dynamic, and we're going to have the tax cuts extended. And, there's going to be a megaphone in about 100-city tour that Trump's going to, Trump has the bully pulpit, and I'm going to add a B in front of bully. And with the messaging, you're going to have about 70, 100 deals, and China's still going to be there standing, but the market's going to react to each one of these. And, there could be some surprises. India has been a surprise. I think moving to a more centric, friendly, that's been the biggest failure of all foreign policy in the last 25 years, is not ignoring India because of the 9/11 problem, where we had to get cozy up to Pakistan. India is the 4th largest economy in the world, and that's the best way to stop this brick thing that's going on, which won't transpire in terms of the dollar losing its reserve currency status. What do you think about that?
I think China matters more. So I have a post on my Substack, SamanthaLaduc.com, which is open. It's not behind a paywall if anyone wants to see it. It's entitled, "This is the Manhattan Project 2.0." So I think China is much more important. You can read about it if you're interested.
All right. Well, it is important because they're trying to destroy and turn China into Japan of 1990s. Do you concur?
They're not going to succeed.
We disagree there.
Well,
All
that's
right.
what makes it a two-way market.
All right, listen, Samantha, this has been just incredible. We've been going at an hour and a half, and I was kind of dragging tail before we started. I think you were tired too, but we've reinvigorated each other. This has been great. Thanks for the energy, Eladio. So, Samantha, I hope you'll consider coming back again. This has been wonderful. Learned so much, and hopefully you enjoyed it. So, I don't know, Samantha, is there anything else you want to touch on? Otherwise, we've been at for an hour and a half. This is beyond the
We're
call of
good.
duty. We're good.
Yeah, no, I thank you for all the questions and those who showed up on a Friday afternoon to enjoy this. For Europe and Asia, it's like a long weekend, so we're way behind in catching up with that R&R. Yeah, I wish everyone a great trading month. Pace yourself, right? And I really appreciate, George, the invite. It's nice to
This has been great. I hope we can do this again, Samantha.
anytime.
Take
Thank you so
care.
much.
Good night, everyone. Bye.
Bye.
Bye, George. Thanks,
Bye.
Samantha.